So the Securities Exchange Act then came along just 1 year later, 1934, still in the midst of the Depression, but rather than talking about companies going public, it was talking about the exchange of stock, okay, and reporting requirements and whatnot that existing companies would have, right? So obviously, if you and I go into the marketplace right now and we want to purchase some stock of Apple, we're not buying that in all likelihood from Apple. We're going to be buying that from another individual or an institutional investor or somebody that chooses to sell that, in an open market. Okay. Apple had their IPO a long time ago, and now the transactions that take place are secondary, right? Okay. So after the initial sale. Okay, and we started to regulate those then with the Securities Exchange Act in 34 and set up the SEC, right? So being public, right, they have to file forms with the stock exchange itself that they're listed on, either the New York Stock Exchange or the NASDAQ, are the two major ones. There are smaller and there are regional stock exchanges, and it affects these people, right, business people, accountants, lawyers, investors, people that are involved. That presumably is the NASDAQ, I'm not sure, and that is where the New York Stock Exchange is, in New York City, both of them. So again, we talk about, materiality, right, and persons liable. And here we talk about, insider information and things like that can happen. Again, with the secondary market, we might talk about an example there. Enron was a company that's been 15, 20 years ago now, but their company was starting to go downhill. They engaged in, kind of a long story, but basically buying and selling of options contracts in gas, the natural gas. But anyhow, their company was going downhill, but yet the main shareholders and officers and directors were out in the public saying that it was going swimmingly well. And so the stock was going up in the marketplace, and they were selling, okay, while at the same time obviously encouraging other people to buy, and so it was not a good thing, right? And some people ended up in prison over that, and more importantly and worse was that people went broke over that. So deals with brokers and dealers and corporations, obviously, whose stock is purchased or sold, and the things that they might do. And it can affect, of course, those who aid, abet, and conspire to defraud. So for damages, the plaintiff has to prove there's got to be losses, right? Excessive paid and received and measured at the time of the purchase. So, again, you might mitigate, right? So you might get some bad information, buy a stock, the stock goes down, and you have to sell it at a loss, okay? But you don't get the whole value that you paid for it. You'd only get the difference between what you paid and what you ultimately sold it for. And there, a lot of these end up, that I see nowadays, I don't see a lot of individuals going after companies for these things, but class action things where a group of shareholders will complain that the company did some things incorrectly, okay? And so it ends up being a class action lawsuit representing all those shareholders against the company that may have misrepresented some information, whatever the case may be. So a plaintiff must establish the existence of, again, material misrepresentation or omission, okay, etc. So insider, we talk about insider trading, okay, and these things are really important. An insider is anybody who owns more than 10% of a company's stock, or anybody who is a director or an officer. And I've seen this even extend further than that to other people that have access to inside information that they might be able to profit from, right? Okay, so insiders must file within 10 days. So they have to let people know what they're doing. The important thing about this is that nobody's trying to restrict an insider's ability to buy or sell stock within their company. Okay, there's certainly nothing wrong with that. In fact, you'd encourage people to purchase stock in the company where they're working, right, or that they run. Okay, what they can't do is use information to make short-term profits. So if they know that they're going to announce that their earnings are really, really good, and so they think the stock's going to pop up, and so they buy a bunch of shares on the day before the earnings announcement, and then they sell them a week later when the stock, went up immensely, okay, that's an insider transaction that's illegal. Okay, normally insiders, especially in big companies and big CEOs that have lots of money, they kind of report even a year in advance maybe. These are my planned purchases, okay, or these are my planned sales. They don't necessarily have to be on an exact date. They don't have to say I'm gonna sell 10,000 shares on October 15th or something like that. But they within the fourth quarter I plan to sell. So they have to let people know that. Okay. And again, this is information that's non-public, or at least non-public as yet. Right, so folks that are insiders can't profit from that information. And we go back to old Martha. She obviously attempted to profit from some information that was illegal. And there's your Enron thing. I think I've showed those before. You guys can kind of look at those. So let's stop there and we'll come back then and maybe hit the rest of this. So